Imagine you borrow money, but instead of paying interest on your loan, the lender gives you a cash bonus instead. Now this might sound like an unusual scenario, but getting paid to borrow money, also known as negative interest rate, is more common than you think, and it can have wide-ranging implications. Hi, my name is Chris Kovalchuk, and I'm an Associate Portfolio Manager at Claret Asset Management. And today, I'm going to explain how negative interest rates and negative yielding bonds work, and what they mean for consumers and the economy. When we talk about negative interest rates, we need to first understand how bonds work. A bond is a form of debt which can last as long as a few weeks to several years or even decades. Unless something goes seriously wrong, you will get back the full amount of money you invested. Bond issuers make regular interest payments to the bondholders over a bond's lifespan until their maturity. This fixed rate of return investors receive on a bond is called the coupon. Why is it called a coupon? Before the internet and technological innovations, bonds were sold as pieces of paper with coupons attached, which you would turn in for cash. Now, this coupon and the bond price have a very important relationship, which is called the yield. A bond's yield refers to the expected earnings generated and realized on a fixed income investment over a particular period of time, and is expressed as a percentage or interest rate. If the price of a bond decreases, the yield increases, and vice versa. So how do we get a negative interest rate? Normally, a lender will lend money to a borrower and expect to receive an interest payment with a positive interest rate. That interest rate is what gives you a literal interest in lending to compensate you for the risk you are undertaking. But negative interest rates mean that a lender actually pays a borrower to take money off their hands. An example is if I agree to loan you $100, and in 1 year's time, you repay me $95. That's a 5% return to you and a 5% loss for me. Now, I know what you're thinking. Doesn't this go against the fundamental laws of capitalism? In fact, negative interest rates are not uncommon. In August of 2019, Jinx Bank, Denmark's third largest bank, began offering borrowers a 10-year loan at an annual rate of negative 0.5%. If we fast forward to today, as of the end of September 2021, bonds worth more than 14.8 trillion US, or more than a fifth of all debt issued by governments and companies around the world, are trading with negative yields. So how does this happen? How did we get into a position where borrowers are earning money on their debt? Over the last decade, global economies have seen low growth. Central banks have been reducing interest rates and injecting money into the economy through quantitative easing, or QE. The goal is to encourage people to spend or invest their money in riskier assets, instead of hoarding their cash in bank accounts. This strategy also worked on a wider scale with banks themselves. The European Central Bank was charging European banks a negative rate to hold their money, in the hopes of encouraging banks to lend out their capital. There's a good reason why you'd want to take advantage of these negative interest rates and invest your money instead of hoarding cash. If a bank was charging you 0.5% to hold cash in your bank account, but you can buy a bond with a negative 0.25% interest rate, that makes a lot of sense financially, as you'd be reducing your losses significantly. Another reason for taking advantage of negative interest rates is to shield your assets from deflation. Deflation is when the general price levels in a country are falling, as opposed to inflation when prices are rising. Deflation can be caused by an increase in productivity, a decrease in overall demand, or a decrease in the volume of credit in the economy. Let's say you had a 5% return, but inflation was 2%. That means you had an approximate real return of 3%, because your money can buy you 3% more in today's dollars. But let's say you had a deflation of 2% instead. In that case, you would enjoy a 7% real return. If an investor holds onto a negative yielding bond until maturity, they are guaranteed to lose money. However, if they anticipate rates to become even more negative, increasing the price further, this could lead to a positive return when sold. This is what we like to call the greater fool theory. You buy this bond in the hopes that someone else will be buying it from you later at a higher price. However, there will come a time when that bond will mature, and pay you less than what you paid for it. Investors who do this need to remember to sell the bond prior to maturity. They also need to make sure they can find a buyer. Thanks for watching today's video. If you want to learn more about negative interest rates, I'm going to offer you an amazing opportunity. I will happily borrow $1,000 from you, and in a year's time, I'll pay you back $950. That's a no-brainer, right? For more investment tips, visit our website at claret.ca, or get in touch with me directly by clicking on the link in the description. And don't forget to click on the subscribe button below.